If you struggle to learn trading online, then this is the video for you. If you want to do this for your pension later, to retire, or even you just would like to make a living out of it. That is having a good trading plan with a very good trading strategy. It needs to find consistency into it to understand what is being proactive and what means reactive. So here you can see a student result with 6 winning trades and 8 losing trades, first using a demo account, and with a result of losing $800, making $3,007, and you can see here how the student made here $2,207 by having always a lot of trading signals to make $500 and losing $100 only in average. We're going through now with the trading platform and then also what the trading plan is, how to use it, and then with an exercise that you can improve your trading. And I'm telling you, if you are doing this within minimum couple of times, you will see already that you're advancing and becoming a better trader. So first of all, we're going into the trading plan. That means just a bit of a sneak peek, and then I'm going to show you this with the trading platform. So you can see here how the trader saw within the past 1 hour that the market was here wiggling around in this area. And this is the main reason why his drawing is here, that the market is doing the same here, as you can see here. That tells him that the market sticks here in this area and he should be doing 0 trades. If he takes a picture in the beginning and he takes a picture in the end, he will see what was really going on. And you can see here how the market was here sticking into this area. You can see here also how he was doing a trade with $100 adjusted. It could have been a $750 trade. Instead, it was like $100 or $200 around. On another day, the same game again. You can see here how the market is just like here pushing up. But now we have here this bigger structure high, and that is telling us that the market will have less momentum. That means it goes into a consolidation phase. How to know that the market goes into a consolidation phase, has less momentum, and how to know that the market has more momentum and pushes through. And this comes with clear rules based on a trading strategy that was made based on experience. So you can see here a picture in the beginning, consolidation phase should happen. Picture 2, consolidation phase really happened, as you can see here, right? So this is just something what is very important. And then the last picture is here you can see how the market was going up very strongly. The drawing shows us that the market should continue to go up instead of going down. Why? Because you literally can see here that the market is pressing here up higher highs, in this case, and higher lows. And then this downsell made the market more weaker. So we can expect that the market is going up here. This is what the drawing is showing us. Just that the market would continue to go up, stays here in this area, picture in the beginning, picture in the end. And as you can see here, this is also what really happened. The market did not make it towards this high. And the trader was able, with a $100 adjustment, it is a $500 winning trade. So let's first go with the trading platform. We use TradingView. Make sure you're signed up. The Google account is really cool on this one. You can use here on the top left side here the language. And then you also use here the 1-minute chart. You use normal candles. And important here is the market. So we get often the question, JT, is it possible to trade gold, silver, or other markets? And my answer to this is, it is possible. But let me explain you one thing before you start wasting your time here. Because if you trade Euro US dollar, for example, Euro US dollar, or better is if you trade the S&P 500 futures. The S&P 500 futures is within Central Time, 9 a.m. to like 4 p.m. very attractive. From 9 a.m. Central Time to 4 p.m. anywhere there like 1 or 2 hours. If you trade the S&P 500 in that area, within 1 or 2 hours, you will find very often within 5 weeks, 20 to 30 possibilities. That's just our experience so far, not a promise, very important, where we can adjust $100 a trade that we lose an average $100, but get $500 out or even more in average for every winning trade. Did you understand it? And that's just very important to understand, because if you take now gold into consideration, if you take the Euro US dollar 6E in the future, if you take silver, for example, then the problem is if you trade there for 5 hours, even though Nasdaq, by the way, if you trade for 5 hours, you maybe will find around the half amount, maybe like 15 signals where you can adjust $100 but maybe just get $300 an average out or $200 an average out. So it's extremely less. That means if you have a good market where you sit down for an hour and you have 4 times the amount of signals, like possibilities to trade, and also the double or 3 times more into the opportunity to make more with the money that you put in for each trade, this is what will help you way more than trading just a market that is worse, right? So there's really like better and worse. There's really a better trading strategy. There's a worse trading strategy, especially if you just need 1 or 2 hours always in a routine. You can be freely within 1 or 2 times a week or 5 times a week, whenever you like, between 9 a.m. and 4 p.m. Central Time. But with a lot of other trading strategies or with markets, you have to sit down for 5 hours, for 6 hours. And this is what can be very tiring if you have already a full-time job, if you cannot be fully committed with 100% of your energy. And of course, if you don't have anybody else who is instructing you, what is very important. And for that reason, I made this video, or we have this video here, that is a trading plan that you know exactly what to do and how to do it. Please use always a demo account. So we take the ES1 exclamation mark in consideration. Using the demo account, it means top right side. Here you find the paper trading account. A lot of people like to trade in the beginning, but I think the most important thing is first to watch. And then here on the left side, you have the tools. Make sure you go where the brush is, and then you get your direct angle, a star in, and then the path tool. Make sure you get your star in. And then from there on, make sure you make a square from 11:25 to 12:25, just within 1 hour, as you can see here, 12:25. If you do that, this means it's an hour. If you just take the 1 minute chart, the references are so small that when adjusting here $100, you get your risk reward ratio of 5.4, as you can see here, just with the candle as reference for entry and stop placement. If you take like a 5 minute chart, that is not possible, because now the red candles has references like here. If you adjust here $100, check this out, the same length would make maybe $200 or maybe like 3.8. If the market had passed this length and would do it here around again, you can see here maybe a risk reward ratio, okay, 4.5 in this case, but it's just very unrealistic. Why? Because the market is having a support. That means it's sort of, I like more to say resistance, because resistance is dragging down momentum. Resistance is dragging down length and moves, and everywhere you have resistances, the market breaks down. So we can usually assume, because the market was pushing a very strong up, that the market is going here into a consolidation phase in this area. And for that reason, we can just adjust to maybe $100 to get $167 out using the 1 minute chart. But in a 1 minute chart, check this out, this small red candle with $100 adjusted, just towards here, it can be $700, 7.33 is the risk reward ratio. So we need 3 things. This is a video you can slow down, you can watch it over again. We have here 3 things. The first one is your computer time. That means the time you attempt to trade 1 hour. The second thing is, if you compare the past hour within the move, what the market did. What did you see here? You see the market did this length, right? So just move now both forward, and you'll see like, oh, this does not make any sense, because the market has here a lot of resistances. It would make more sense that the market is just like playing here around and sticks here in a consolidation phase. This means the market moves in a direction we can make and lose a lot of money. This means the market is just in a consolidation phase. We can most likely just lose a lot of money. It means like just with not one single trade, because with one single trade, we could, if there's movement, just make good money. But here with a lot of trades, we can lose here a lot of money, because the market needs to push out. And here it's obviously that it does not want to push out. We have here now talked about 3 things. The first thing is about our trading time. The second thing is about like the path, the movement, what is realistic. And the third thing is the resistance. That means where the market is stopping its momentum. Very important. There is support from top to bottom. There is resistance from bottom to top. But those are all to treat like resistances. I think it's way more easier, because the support is like, oh, it can be a support and movement. But I think it's sort of wrong. I believe in more, for myself, If there's a resistance, it slows down the market. And for that reason, I think it should be treated more as a resistance. It should be called almost a resistance because it's resisting here. And this is what you will see now in the videos, in the pictures that I prepared now, and also in other videos that I have here on this channel. Very important is, please make sure you write down following things. You have the 3 things in the picture. You use this 1-minute chart. You use the S&P 500 towards the times, 9 a.m. to 4 p.m. Central Time. You have here a 2 days period that you're seeing here. Make sure you don't zoom out too much on the right side, that you're here zoomed in. And now, very important is, go here to this picture area, download this image and save it up. You would like to save it up because now you would like to make sure that you take a picture in the beginning and you take a picture in the end and you're looking what the market did. This is not something you will learn within just like a couple of time. You just do it like 10 times, or you do it like 2 months and you got it. This is what you should do the next years. Why? Because you will see consistent. Is the market copying what it did past hours? This is what the market does very often. And you will see also if the market gets into inconsistency, you will find patterns. Like here, for example, you see here this consolidation phase here. You see it makes less sense to draw in that the market goes up here because there's this down momentum again. And because of this target here, I think now it makes more sense because I was talking in the beginning. Here you see here this high of bigger structure. And this breaks momentum down in this case. You see how the market was flattening out. Every time the market goes above its own high and then just comes back like this is also weakness. This is where the consolidation phase starts here once it came back. This is what you see here. And the trading plan literally shows us that if the market goes away and you see it's going back, it wants to go towards here the circle. If it goes up, it wants to go towards the circle. Important is not to sell here. It's more like for the buying trade good because we have here this buying momentum because it's a trend trading strategy. Now let's just look here. You see how the market was going off, came there, and this is where the trader had the opportunity to adjust $100 to get a $750 trade towards the target. But in this case, he was exiting here earlier. He was learning how to enter the trade. In this case, he just got here with a exit here down here of $187. He had the opportunity to exit here, but he did not have the experience he needed. But it's all right because his exit was down here instead of up here. It would have been literally like $500 or $700 up here. Let's go to the next example. Picture 1 again. We have here, if you just mirror it, it should be literally just looking like this. Now we have a very bigger structure high. And very often, if you take a picture in the beginning and in the end, you will see that the market is just doing this one. So not just because you're seeing this video now, because you're learning from this video how to look at the market, how you get your opinion about it. This is the result here, as you can see here, what the market really did. And then now you see how the trader has a losing trade. Why does he has here a losing trade, and why did he do it before a winning trade? Because before the market was going down, and then it's very obviously that it wants to go back up, as you can see in here. So it is literally listed that if the market, write this down, if the market does higher lows, that means a low is a red and a green candle. This is an uptrend. You can see here how the market does red, green, neutral, red, green, higher, red, green, higher. And now this red, green, he was trading. So it started here the trend. It is obviously in what direction the market wanted to go. You can see here more green and red candles, and he trades up towards this consolidation phase. If you look at the other one, and green, red, by the way, is a high, and green, red in combination is a lower high, and this is the downtrend. So as you see here, just because having here a small downtrend, it's also not good to trade down because the trading plan says the market likes to stick here, and it's not good to trade against that. So now you're seeing here this consolidation phase. When you zoom in, you do see that the market does here also higher lows. Yes, that's right. But it is in this consolidation phase inside. And our trading plan says here, this is what we need to prioritize, that we're getting squeezed here. Like you see here, he can place here a lot of trades. He would have here a lot of losing trades. That means a lot of losing trades by trying to catch a momentum, like small moves. But we need to have something like this one, moves like this one, as you saw here, moves like when they go down and then goes up, that we see clearly where it likes to go at. That's just something that's very important. Last example, very important, is here. Here you see how the market is getting, and this is important. It's not just something what I draw in and then you just see it. It's something you can see also by yourself. Just look how I draw in the bigger structure. Look how the market is taking off higher highs the whole time and does not prioritize here the higher lows too much. You find here one higher low and a second and a third higher low. Yes, that was good for the day. But now here on the right side, you see how the market here again does higher lows. the market does this push down again, and that shows us that the market does not like to go towards this high very often. It shows us the market just goes here and then starts going in a consolidation phase, because we have this push up that is stronger than the push down, as you can see here. That means the push up is still strong here very newly. That means a bit going up makes sense, but not that it reaches the highest point. This is what you will see very often. And now in the second picture, you see that was also the case. In the second picture, you can see the trader had enough experience because he's doing this principle already since a half year minimum. And you see here with the $100 adjustments, it's a $500 trade towards those targets. You see here, those targets here are very nearby. And this target here of bigger structure is far away. That means like very often the market just shoots with one candle towards these targets. And that's why he had this exit point up here. I'll zoom a bit in. And this is where you see the trade. That means you can see here, we place the anchor VWAP. You'll find a video about the anchor VWAP more over this channel. Cuts up, market should shoot up, come back towards the anchor VWAP, touch, higher low as you can see here, and $100 adjusted. It's a $500 trade using this high. So your routine should be always taking a picture in the beginning, take a picture in the end. This trading strategy in this case, where you can lose $100 on average and get $500 on average, is always better than the opposite. Trading needs always money, very important. You cannot start from zero. You need to have money when it comes to trading, but that does not mean you should trade live in the beginning. That means you should use always a demo account in the beginning. You should see that you're getting to $400 to $1,200 a week or a month consistent for a couple of times. You should be seeing that even though you lose 8 times and have 6 winning trades, that you can still make a lot of money with this demo account. And if that's ready, then there are people that can start with micro futures with $10 a trade. They can go up to $30 a trade, to $100 a trade, whatever it is. It's just like to use the demo account in the beginning. No promises in this video. This is just only for education purposes. This is where you see where we have students that are making money off trading first in the demo account. We have students, then they go with their own experience using their real money account. And we hope literally that we can help you with this video, that you can become a better trader.